grab your coffee and pull up a chair, because today we're pulling back the curtain on a machine that most people never get to see from the inside. On June 12, 2026, SpaceX executed the largest initial public offering, or IPO, in stock market history. But look, we aren't here to just recap the breaking news or get caught up in all the Wall Street hype. Instead, we're going to use this massive event as the perfect real-world case study for this explainer to show you exactly how the IPO game actually works. Whether you're a small business owner, a solopreneur, or just an everyday investor, understanding these hidden mechanics is absolutely crucial. Honestly, it's going to change exactly how you see the entire business world.
Okay, let's hook you right out of the gate here. $1.77 trillion. That was the headline figure plastered across literally every financial network on IPO day. It's a completely astronomical number, right? But to understand what this really means, we have to look past those flashy headlines and dive straight into the actual mechanics of the deal. Because what the news anchors were shouting on TV and what was actually happening in the bank accounts of SpaceX and its founders, well, those are two entirely different things.
Here's the single most common mistake people make when reading about IPOs. There is a massive critical difference between the valuation and the raise. I'm going to say that again because it's so important. The valuation and the raise are not the same thing. The valuation, that $1.77 trillion, is the total implied worth of the entire company. But the raise, the $75 billion, that's the actual cash the company collected from selling new shares to the public at $135 a pop. Think of it like this. Valuation is what the market says the whole pie is worth. The raise is the actual cash the company put in its pocket that day. Two completely different numbers.
Which brings us to the math. There is roughly a $1.7 trillion gap between the cash SpaceX actually raised and the total value of the company. That massive gap, it's strictly paper wealth. It belongs to existing shareholders like Elon Musk, the early venture capital investors, and long-term employees. But here is the crazy secret of IPO day. None of those insiders saw a single dollar of cash from the IPO raise itself. No way, right? But it's true. The $75 billion went directly into the company's treasury, not to the founders. Their private shares just finally got a public price tag.
So the totally obvious question here is, if the founders and early backers aren't walking away with billions in cash on IPO day, when do they actually get paid? It's a reality that most casual observers just get completely wrong. Let's break it down. Here is the exact sequence of how the big money is made. Step 1. Early investors and founders get their shares dirt cheap, sometimes even for free, years before the IPO. Step 2. The company goes public and raises cash by selling brand new shares. This dilutes everyone's slice of the pie, but ideally, it makes the whole pie much bigger. Step 3. The insiders wait out a mandatory lockup period. And finally, Step 4. They sell their shares on the open market. You know those everyday public buyers who jump in right after the IPO? They are basically just providing the necessary liquidity so those insiders can finally cash out in Step 4.
See, when SpaceX went public on June 12, 2026, insiders couldn't just dump their shares. Wall Street enforces a lockup period, usually about 180 days. It's designed to prevent a massive flood of shares from just totally crashing the stock price on day one. So for SpaceX, the real test wasn't June at all. It's December 2026. That is the 180-day cliff. That's the exact moment when potentially trillions in paper wealth can finally hit the open market. If the stock has run up, insiders will sell, and that selling pressure is what truly tests if a company is actually worth its sky-high valuation.
Now let's talk about the folks actually orchestrating this whole event. Investment banks like Goldman Sachs, Morgan Stanley, and JP Morgan run the process. They're what you call the book runners, and let me tell you, they do not work for cheap. Their fee is a straight cut of the total raise, typically ranging from 3.5% to 7%. On a $75 billion raise, these banks split roughly $2.5 to $5 billion in fees. Talk about a payday for a few weeks of work, right? But honestly, the fee isn't even their greatest prize. Their true power is allocation. They get to decide exactly which of their favorite clients gets to buy those IPO shares.
And this allocation power? It creates a massive structural conflict of interest. The company going public, SpaceX in this case, wants to raise the absolute maximum amount of cash possible. But the bankers? They want a pop. They deliberately underprice the stock so it jumps, say, 15 to 20% on day one. Why would they do that? Because the bank just allocated those underpriced shares to their absolute best institutional clients. Those clients make an immediate fortune, and you better believe they will happily come back to that same bank for the next deal. The company wants the cash. The banker wants a happy client. Let's make the cost of that underpricing super concrete. If SpaceX priced its shares at $135 and the stock opens on day one and immediately jumps to $160, the company just left roughly $14 billion real dollars on the table. $14 billion. That is cash that went directly into the pockets of the IPO day buyers instead of going into SpaceX's treasury to, build rockets. It's a crazy dynamic, but the bankers almost always win this tug of war.
So, who actually gets their hands on these IPO shares? Well, historically, big institutions like hedge funds and pension funds hold a massive structural advantage, usually grabbing over 90% of the pie. Everyday retail investors, people like us with a standard brokerage account, we usually have to fight over a measly 5 to 10%. But SpaceX actually disrupted this. They flipped the script by reserving a full 30% of the allocation, that's roughly $22.5 billion worth, specifically for everyday retail accounts. It was a highly calculated move to give Main Street the exact same entry point as Wall Street.
But look, just because Wall Street institutions had to share a bigger piece of the pie doesn't mean they changed their game. Listen to this quote from Morningstar on IPO day regarding SpaceX. They called it, "overvalued on fundamentals, worth less than half its IPO price." Ouch. That is incredibly harsh institutional sentiment. You would think, hearing a major warning like that, the big funds would run away screaming, right? But they didn't run away. They bought it anyway. Why? They bought it to flip. Institutions loudly called the stock overvalued to the press and then quietly bought millions of shares. Think about it. They bought at $135. They let retail enthusiasm push it up to $160. They booked a lightning-fast 15% return and just walked away. Everyday investors often think they are buying alongside smart money with long-term conviction. But the reality? They're often just providing the exit liquidity for smart money that's playing a completely different, very short-term game.
And while we're clearing up Wall Street terms, let's briefly look at market makers like Citadel Securities and Virtue Financial. Do not confuse them with the investment bank underwriters we just talked about. Underwriters basically leave the party after IPO day. Market makers, they stay forever. They are the underlying plumbing of the stock market. They quote a buy price and a sell price simultaneously, and they pocket the difference, which is called the spread. They might make just 4 cents a share, but when you do that millions of times a day, every single day, it adds up to billions in reliable profit.
Okay, so what is the actual reality underneath all this financial maneuvering and hype? If we look at the source data, there are real, undeniable risks buried here. For instance, SpaceX uses a dual-class share structure. That means the institutions that just handed over $75 billion have no actual control. They literally cannot fire Elon Musk, even if he completely fails to deliver. Furthermore, despite Starlink generating billions in operating income, SpaceX as a whole posted a net loss of roughly $1.9 billion in 2025. Why? Because of the massive cash burn required to develop Starship and XAI infrastructure. That new IPO cash is literally funding those ongoing high-risk bets.
Now, you might be sitting there thinking, okay, I'm a solopreneur. I own a local small business. I am never, ever going to take a company public. Why does any of this matter to me? I'll tell you exactly why. Because public market valuations set the trickle-down benchmarks for the entire business world. The multiples and the rules established in mega deals like SpaceX, they eventually dictate the terms of how private equity and acquirers value smaller private businesses. When public multiples stretch, private multiples stretch. When public markets tighten, it hits Main Street acquisitions. The math might start on Wall Street, but trust me, it ends at your negotiating table. So, to wrap this all up, the biggest lesson from the SpaceX IPO really isn't about rockets at all. It's about access. The people with access to the deal before it opens always have a structural advantage over the people buying after. Understanding that dynamic, knowing the crucial difference between a raise and a valuation, understanding lockups, and not confusing a banker's day one hype for actual long-term analysis, that is the most valuable thing you can take away from this explainer. The system heavily rewards those who understand the rules of the game. So the next time a mega IPO dominates the headlines, ask yourself, are you just buying the hype or are you finally playing the real game?